Today we're going to talk about one of the ways Canadian investors can make a huge amount of money using very simple stock mechanics in an industry that produces huge free cash flows and yet has a whole bunch of barriers to growth. Today we're going to be talking about oil and gas investing. We're going to be following the strategies of a guy named Eric Nuttall. He's one of those people that is just like the best known voice for Canadian oil and gas investing in the Canadian space. Talks on BNN all the time. He actually posts here on YouTube. He just talks and has a huge wealth of knowledge that he shares with Canadian investors about this space. We're going to talk about one of the companies that he thinks has one of the best opportunities to make a huge amount of short, medium-term gains for Canadian investors. And of course, we're going to talk about what I think about this company, what I think about it long-term, and how I can imagine this fitting into a Canadian investor's portfolio. Welcome to Golden Arch Investing. My name is Liam. On this channel, we love to talk about investing in Canada. If that interests you at all, please do like the video, subscribe to the channel. It makes a huge difference and it doesn't cost anything. So today we're talking about MEG Energy. It's one of those names you've seen, up and down depending on the times. When it was flying high, it was super popular among a lot of retail investors, maybe a little bit less so over the last little while. MEG Energy is a, southern Athabasca, so in that oil sands basin. They do thermal energy. They're a smaller player, about $5 billion market cap. And as a smaller player, they've really had to find a way to make themselves sort of a different opportunity for investors. And one of the strategies they have to do that is honestly a somewhat similar strategy as a lot of the other mid-small caps, and that is share buybacks. They have been really focused on the ability to make real shareholder returns out of their moves with their free cash flows and to really evaluate, the value of growth versus buybacks, shareholder returns. And I think the way they've gone about this is really, really interesting and super valuable right now because we're at this point in the Canadian oil and gas industry where nothing seems certain. We've heard a million promises made over the campaign trail, and now that the election is over, it's up to these companies to sort of navigate this space as we wait for politicians to finally announce actual concrete plans and show us exactly what's going to happen. Now, the opportunity with MEG is even more interesting because of the way they are completely agnostic to political changes over the next 5 years. They do not care about what the government plans, what exactly happens to the industry. They are completely able to return huge amounts of money and bring huge value to shareholders if literally nothing changes in the Canadian oil and gas industry. And that is a worst case scenario. So before we get into sort of exactly what their strategy is, what they're doing with these share buybacks and why it's so valuable, I want to talk some numbers with you guys just to show you exactly where this company sits and what exactly they've been doing, how they've been growing, and where their opportunity lies. Now I'm going to throw the FinChat home screen for these guys up on the screen for you. So we got a whole bunch of numbers here. We see their market cap, $5 billion. They're currently sitting at a share price of just shy of $20 Canadian with a PE of about 10. And of course, you look at some revenue growth numbers that are not impressive. 5.5% 5-year, 6% 3-year, it's about 6% 10-year. So if you're saying they're growing between 5 and 6% a year, every single year in revenues, that's not huge. That's not huge. That doesn't necessarily justify the PE without looking down to the next sort of line there where we see EPS. And the EPS growth is insane. You're looking at what is that? 27% 3-year, 54, almost 55% 5-year. Which is huge. And you see that's like pretty unique for the last 5 years because the 10-year number is only at 14. So what exactly does this show us? Why does this matter to me? Well, let's look at the next 12-month projection here. We see 28.71 is a projected price target. So that's a value of what, $8 a share just about. That's a huge amount for the price to grow. Best part, look at the PE, it's dropping. You're telling me this company is going to go up maybe, let's say close to 50% in the 40s, 40% range. And yet we're going to see PE drop. That seems pretty, unbelievable for a company just growing like this, right? There must be a catch. And of course, the catch is that the biggest way they're doing this is thanks to share buybacks. That's how you get that EPS number to look fantastic. It's just share buybacks are a very unique vehicle to actually make companies like this return more and more to shareholders. And they're really uniquely positioned to help Canadian oil and gas companies right now. I think that's why MEG's strategy and sort of the reason that Eric has seen so much value in these guys so unique and why Canadian retail investors should pay attention. One of the biggest challenges for us is we're trying to invest in this resource space, be it critical minerals, gold mines, oil and gas, trying to invest in this resource space without any concrete plan for growth. And so for a lot of these companies, if growth doesn't happen, there's no return for us. You might get a shareholder, a dividend. Maybe they'll do some small buybacks, right? But there's no real return for us in those situations without growth. Here, on the other hand, MEG's strategy, and the strategy that a lot of companies are sort of slowly adopting, is to take advantage of the stagnation. These guys, free cash flow, let's say it's in the range of 800 million a year. 800 million free cash flow a year. You're looking at, how much of that is going to CapEx, how much of that is going to maintenance, right? How much of that is going to buybacks, how much of that's going to the dividend. On a normal year, you would see, some buybacks. We've seen somewhere in the range, 5, 10, 15% of shares outstanding drops over some of the past years, which is a great buyback scheme in the grand scheme of things. But it's not really moving the needle for a lot of investors. When you think about share buybacks and you think about big companies that have done it, I think probably the premier example, the biggest one, is Apple, of course, right? They've bought back literally hundreds of billions of dollars of shares over the last several years. And you've seen that really help their share price hold up, right? They've made it through this period as they sort of mature into this not really growing company. Instead, you're focused on profitability, right? We've seen that story play out on the sort of big screen, right? That's if not one of the largest companies on earth has been playing that story. And so shareholders do have appreciation for the value of buybacks, but I don't think they get it in this space. Oil and gas returns huge free cash flows to these companies. And typically we see a lot of that free cash flow immediately going to capital expenditures to grow the business, right? To mine more, to drill more, to, produce more. Because at the end of the day, a shareholder wants growth so that they see their shares increase, so they see that company grow. It's a cycle. You want to see growth in your investments. That's why you're an investor. But there are certain times where that's just like artificially not possible. And I think now is one of those times. We've got instability, right? We do have a new government, right? They're the same brand as the last one, but maybe they're going to do things different, or maybe they're not. We don't know. We've got this question of global recession. We've seen the oil price drop dramatically, right? It was $80 a barrel not that long ago. We're seeing 60 now, right? Maybe sub 60. We've seen some bad GDP numbers come out for the US and Canada, but is that just because of the imports, right? Is that just because we've been front loading all these imports and that's why the GDP looks bad, because imports are deducted? We've seen these questions about reciprocal tariffs. Is it going to crash the global economy? Are we going to see, the ports completely dry up? Or is a deal coming this week? We don't know. And so companies like these Canadian oil and gas producers that need to expend huge amounts of money in order to invest in their company, to grow capital expenditures, to make these purchases, can't. It just doesn't make sense. On top of that, in Canada, there might be a production cap, emissions cap, right? There's like actual political pressure stopping them from growing. So what are they to do with all this free cash flow? That's where the buybacks come in. These guys, over the next 5 years, at $60 WTI, are expected to buy back 30% of the company. That's straight from Eric there, straight from Eric Nuttall, who, again, one of the most well-respected, most knowledgeable investors in this space. 30% of the company. On top of that, think of what that could do in the frame of like EPS numbers, right? If they buy back 30% of the company in 5 years, right, EPS is going to be dramatically higher. Right, we can expect there to be some efficiency gains, right, as there have been over the last several decades. We can expect there to maybe be some movement at the end of that 5-year period when we see a new election. Maybe we see this industry unleashed. And that's at $60 WTI. There's a huge amount of opportunity there. An investor could expect to see some pretty good returns in that scenario. But that's the bear case. $70 oil, which was, a month and a half ago, 2 months ago. Now we're looking at 60% of shares bought back. Over half the company bought back in 5 years. So I want to throw a hypothetical at you guys. I want to imagine, you're a regular investor, you're dollar cost averaging a small amount of money. This is a part of your portfolio, right? This is by no means your whole portfolio, but a part of your portfolio. You're putting a couple $100 a month into this company. Let's say you start out with maybe $1,000 you put in, and you're sort of sitting on your hand, you're watching the ball roll a little bit. Well, that $1,000 over the 5-year period, if literally nothing changes in Canada, if we see none of the promises kept, none of the growth happen, we see, same old, you got tricked. Well, your investment grew 60%. You collected a dividend the whole time. And now there's a new election where this industry could be completely unleashed. If we see that stagnation in Canada, I'm pretty confident the electorate will pick a different party to be the next government. Right? If we see literally nothing change and this government run for 15, 20 years, right? I don't think that's likely. I think instead, next election, you're likely to see things completely change and the government unleash the energy industry, right? Reduce some of that regulation, reduce some of that, that cap on the industry, increase the possibility of pipelines. So you would see what, a 60% gain, low and slow, and then boom. So your $1,000 investment, you could be seeing $1,600, which then, let's say what, the valuation on that would double in a scenario where all of a sudden all of that restriction was dropped. So that $1,600 could be 32, right? That's a pretty solid gain, 300% in a couple of years. But then what if things actually go well? What if you see the Canadian economy not stagnate? What if you see projects built? What if you see things actually move? And yet you still see this company buying back shares? What if you see oil jump up to $80 a barrel? Right? After 5 years, you could expect that, US shale, if it's declining now, if we see a recession, I mean, that growth is off the table. And, as far as other basins go, there's so much instability in just about every other basin. OPEC could make cuts again. They're meeting in the not so distant future, right? They might make some sort of drastic decisions there, but 5 years from now, who knows? 5 years ago, these guys are flooding the market. So clearly their policy changes all the time. So you could be looking at $80, $90 WTI. So then what's the valuation on this company? Right? If we're saying that at 70, after 5 years with this sort of relaxed opening of the structure, it's up to 3,200. If we see growth in Canada, if we see the ability for the industry to actually grow, we see the valuation quadruple, quintuple, right? It would not be unreasonable to see these guys at a $20 billion market cap, right? That's $4,000 a share before the buybacks. Sorry, I said a share. $4,000 on your $1,000 investment before the buybacks. So if you get an extra 60% on that, you could be looking at literally hundreds of percent in 5 years. So your worst case scenario is making a good gain. And your best case scenario is making a huge gain. And you don't have to stress about the industry the whole time. Because this company and this strategy of investing and being prepared for the worst and having the company use the dynamics of the market to help you, well, it simply doesn't depend on an industry that you can't control. I think it's a really smart idea. I think for a lot of oil and gas investors out there who are looking for something that they can invest in that gives them the opportunity for the upside of this industry, but protects them a little from the downside, this is one of those names that should be high on your list. And I want to hear what you guys think about this. Do you agree? Do you think this is a good move? Do you like the Eric Nuttall playbook, or do you think this guy has got, the complete wrong idea and you instead are investing for completely different reasons, right? Maybe you're dividend only, right? And you're thinking, man, why would you want these share buybacks when I could be making a dividend? Let me know. I'd love to hear your opinions down in the comments down below. And as always, I hope I see you in the next one.